Are we heading into Great Depression 2020? Coming up live shortly. Hi, welcome to Convex Up channel. I'm Bonnie Ritzon, your host for Expert Insight at Live, a broadcast series featuring forums and interviews with industry thought leaders on market, policy, strategy, technology, and innovation that steer the industry growth. If you have any inquiries or questions, kindly post them through the Q&A message box right below the live broadcast window. As the COVID-19 infection cases worldwide passed 21 million, countries among the hardest hit unveiled further measures to battle the rising infections. Countries are expanding ban on non-essential travel, and some are imposing second lockdown. The pandemic has led to the largest rise in unemployment since 1930s, with an estimate of 300 million jobs lost globally and 81% of the global workforce hit by full or partial lockdowns. The second wave or third wave in some countries will certainly hamper efforts to kickstart the already battered economies. Some top economies are predicting losses of up to $8.8 trillion indeed, potentially triggering the worst economic meltdown. So, are we heading into another Great Depression, or this is the greatest depression? Let me welcome our panelists who are connecting with us all the way from Bangkok, Professor Steve Keen and Mr. Paul Gambles. Professor Steve Keen is currently a distinguished research fellow at the Institute for Strategy, Resilience and Security at University College London. He is the author of Debunking Economics and Can We Avoid Another Financial Crisis? And also the developer of open source system dynamics program, Minsky. Next, we have Mr. Paul Gambles, the managing director of MBMG Group Investment Advisory, also a regular expert commentator on CNBC, Bloomberg TV, CCTV, and many more. Also with us today is Dr. Jayan Menon, visiting senior fellow of ICS Yusof Ishar Institute, based currently in Singapore. Dr. Jayan was the lead economist in the office of the chief economist of Asian Development Bank. And last but not the very least, Mr. Jack Cousy, director of strategy of VFS Group, all the way from Australia. Jack is a well-known public speaker on wealth management and wealth creation, and an expert in Asian investing and economic analysis across the region. Our discussion today will be led by Mr. Michael I. Witz, founder of Metallic Partners, and also Michael Witz Media, AsiaTechPodcast.com. Without further ado, I will now hand over this segment to Michael. Over to you, sir.
Hi, this is Michael Witz. Thank you, Barney, for a superb and super introduction. As always, we really, really appreciate it. I also want to personally thank Professor Steve Keen, Dr. Jayan Menon, Mr. Paul Gambles, who I first met, 20 years ago? No, 10 years ago. And Jack Cousy. Thank you all for coming in and doing this. Apparently we're going to start with Professor Steve Keen, who's going to give us a quick sort of 5-minute presentation, then we'll start talking about that as well. Steve, off to you.
Can't hear anything, I'm afraid. I can't hear anything at all, I'm afraid. Nothing coming through at all.
Steve, it appears that you're having some technical problems.
Okay, what about the audio? Let's see.
We can hear you.
I'm afraid I can't hear anything. I'm going to leave and come back in Firefox.
Okay, why don't we do this?
Hoping that works better.
While we're doing that, why don't we go to Dr. Menon to give his presentation? Do you want to share your screen first and start with that? And then we'll come back to Steve when he resolves his audio problems.
Right, sure.
Go ahead,
I think the organizers are going to help with sharing of this screen. So
Okay.
yeah, I think that's
there you go.
yeah, excellent.
Good stuff.
So let me start by thanking all of you, thanking the organizers, and also for having me here today. I'm very pleased to be part of this discussion. I was looking forward to listening to Steve's presentation because I know that he has some interesting views, and I was going to try and continue that discussion by saying those were the longer term effects, and I'll look at the more short to medium term effects. But anyway,
Let's do that.
yeah, we might be able to do that a bit later when we come back to the Q&A.
Sure.
So what I hope to do, next slide please. What I hope to do today is basically talk a bit about the economic impacts. I'll focus mostly on these. And look at what the general state of play is in terms of what the major international organizations think about how this pandemic is affecting countries in this region, mainly the Asia Pacific region. I'll focus more on Asia, East Asia, which is the region I know better and where most of us are based, and also say a bit about the global economy, of course, and talk about what the numbers out there suggest, and not to overemphasize the fact that I think the general position is that there is no Great Depression, emerging. Based on what the international organizations seem to think, at least, they seem to see a sharp contraction, but also an equally sharp rebound next year. So I'll go through those numbers, and I think the diversity in those numbers highlights the need to actually look at the transmission mechanism. So I'll say a little bit about that. But then at the end of the day, I think what really matters is not the numbers, but what the implications are of those numbers, the social consequences. I call them social. It's a general effect on human life. I think we often forget as economists that, this is first and foremost a human tragedy. This horrible virus, which has taken the lives of so many people. And that's terrible in itself. But what is actually also quite bad is the economic consequences of the response to the virus, especially the lockdowns, the prolonged lockdowns in many countries, now returning, as we heard in the introduction, in some countries, and how they have actually, caused so much misery, especially in poor countries. Now, many of us are in developed countries where, it's a huge inconvenience, but it's not a matter of life and death. But it is in many poor countries with large proportions of the poor, and with governments without the capacity to provide, income support or safety nets to keep people even living for prolonged periods, while requiring them to stay at home, right? So, the poor in the informal sector in many countries are forced to leave their dwellings to seek out meager subsistence livelihood. And when you take that away from them, lockdowns will not work. They will be forced to leave their dwellings, and many of them are homeless. So it's a non-issue. Then finally, I'll say a little bit about where we go from here. Okay, so next slide, please. So let's start by looking at the numbers. These are the numbers from the IMF, and there are two sets of numbers from the IMF. The IMF is arguably the best at these sorts of forecasts. They have the most amount of resources dedicated to producing these sorts of numbers. And if you look at them, well, the first thing to note is that they came out with a set of numbers in April, in the first edition of the World Economic Outlook, but very quickly thought they had to revise them in June when they came out with a much more gloomy picture. And they might yet come out with another set of numbers, right, as we go forward. So the latest numbers we have in June is for a global contraction of about 5.4%, of 4.9%. And earlier they thought that the global economy would contract by 3%. But they still see a sharp rebound of 5.4% next year for the world, when earlier in April they thought that the rebound would only be 5%. But for the ASEAN region, or the East Asian region, the ASEAN +3, the forecasts became more gloomy between April and June. You can see, for instance, that the ASEAN 5, the contraction was revised from 0.6, dropping by 0.6% to 2% over these few months. And I think this is broadly consistent with what many private sector forecasters also believe, but not what other regional institutions believe. They are less pessimistic than the IMF. But the story is basically one of deep, sharp contraction, but equally sharp rebound next year. So if you're thinking about recession, depression, this is basically a deep and prolonged recession, but not a depression in the conventional sort of sense of definition of depressions. Next slide, please. So here we have a picture again from the IMF's latest World Economic Outlook update, where we see that clear V-shaped recovery for all groups of countries, right? For China, in yellow, we see the smallest drop and the quickest rebound. In fact, for many countries in the region, the sense is that they will bottom out in the second quarter of this year and then start improving, especially for countries that appear to have the community spread of the virus under control and will not have to reintroduce stringent social distancing measures. This is most countries, it seems, except, well, in the ASEAN region, Philippines and Indonesia are still struggling with community spread. And so the situation is uncertain. But with most others, the second quarter is supposed to be the bottom, and then we recover. So China is the least affected. The blue line, the biggest drop is for so-called advanced economies. And then the brown line is the global average, and the grayish line above it is for the emerging or developing countries as a whole. So for the world, it's that brown line that is just above the blue, and things are pretty bad. They keep slowing quite. The drop is quite sharp, but the rebound is equally sharp. And soon, I guess we imagine that things pretty much go back to some kind of new normal, where you don't fully recover, but most of it's in the past. Next slide, please. In the region, the ADB and the AMRO, the ASEAN +3 Macro Research Office based in Singapore, are less pessimistic. They often are. They're supposed to be more friendly to the countries in this region, being based here. So they don't see as much of a downturn, and they see a sharper recovery. But I think they themselves will be revising these numbers very shortly, because things have actually lasted a lot longer than they have. So let me now try and say a bit about the social impacts. I've already touched on them. I think the longer the lockdowns or the social distancing measures last, the less likely it is that things will just pop back to normal. Firms that go into bankruptcy will not suddenly re-emerge in the new normal. So I think the longer we continue with the social distancing measures, the greater the risk that there'll be less of an economy that remains when we finally remove them, or we finally get on top of this virus, whether through a vaccine or herd immunity. So I think there is a need to not return. I mean, the lesson is we should not return to general lockdowns. It was okay when the virus first hit us. We knew very little then, but now we know a lot more. There's still lots of things we don't know, but we know a lot more. And a general lockdown, I think, is not the way to deal with this virus, but selective measures targeted at vulnerable populations is probably the best way to minimize the harm from the so-called cure, right? The remedy, which is the social distancing measures. That's what we should take away. And this idea that there's a second wave already happening needs to be carefully considered. Just because infections re-emerge doesn't mean it's a second wave, unless you want to eliminate the virus. Some countries are now not flattening the curve any longer. They are looking to eliminate the virus, like New Zealand. They have 4 cases and they're locked down in Auckland. But the Philippines has a few thousand cases every day and they're easing measures. So it depends on what your objective is. If you want to flatten the curve, fine. That is, you don't affect the total number of infections, you just spread them over a longer period of time. But some countries want to eliminate them. So let me try and wrap up now. I understand I've gone a bit over time. I think going forward, I don't see depression in the conventional sense, although I see a deep recession with social consequences, especially with the rise in poverty, a sharp rise in poverty. We already seen the rises in unemployment coming through. Many firms will not come back from if they go into bankruptcy, and they are. And the longer this goes on, the more likely they will be. And many people have suffered irreversible harm. Some have died because of the virus, and many have died because of lockdown measures in very poor countries. And I hope that this is going forward, we don't return to lockdowns, but do selective targeted measures. So no depression, but a big bad recession. Let me stop there and go back to you. Thank you so much for your attention.
Thank you very much, Dr. Menon. I mean, I actually do have a couple of questions, if you don't mind.
Sure.
The one country that we didn't talk about was the United States. So the largest economy in the world, 40 million people out of work. And if you go back and look at statistically, 40 million people over, 328.2 million people in the United States, about a little bit more than 12-point-something% unemployment. If you go back to the Great Depression in 1933 at its height, about 15 million people were unemployed. 125.6 million people, about 11.9%. So the unemployment rate is kind of no different than it was back during the Great Depression in the United States. Now, I have a theory that information travel is probably one of the most important things that we have today that differentiates previous depressions, because back then, people didn't even know there was a depression until it was so far advanced that it was hard to recover from. But I'm wondering why we don't talk about both COVID in the United States, where 180,000 people apparently have died. The US has 25% of the death cases and only, 4% of the world's population. I think we need to address that as well if we're going to look at the global statistics. And also, the US economy contracted 32.9% from a real GDP perspective in the second quarter of 2020. Not my numbers, those are the BLS numbers. What's going to drive us out of that? Because the US economy, as the largest economy in the world, helps drive the global economy, particularly if you're an export-oriented country and you're selling into the US. A lot of countries do. And we're going to address this later with Jack and this sort of regionalification of the world's economies, particularly from a supply chain perspective. But I'm curious about what you think the impact of the US economy is going to be on the rest of the world.
Right. Okay. So I think these are all valid points. I purposely didn't talk about the US, focusing instead on Asia. Mm-hmm. But yeah. So what we have learned from this, first thing is that there've been a few new surprises with this virus. I mean, who would have thought that the most advanced country would be suffering the greatest sort of consequences? And in ASEAN, the star was Vietnam, right? Yeah, in handling this.
And Thailand, to be fair.
And Thailand as well. Yes, that's right. Not countries you would normally select. Singapore did very well until the migrant worker dormitory outbreaks came through. So it's full of surprises. I think the U.S. is still the most important, sort of part of the global economy, not the biggest trading partner in the world economy. That's China. And you've seen how China is rebounding sharply. So that will offset some of the negative effects of a very weakening U.S. economy. That's one thing. China is more globally, connected in that sense. So that's an offset. But yeah, the U.S. will be the country that creates the biggest risk to global recovery, and that's unfortunate. The current administration is interested in actually decoupling from China, and in that process creating some level of deglobalization as well. And so maybe this is, part of the design, but it will be a drag on the world economy. But I think not enough of a drag to push us into a depression. Well, at one level it's semantics, right? As you pointed out quite correctly, the huge numbers of unemployed in the US and elsewhere. So if that's what we should be focused on, I think it is. It doesn't matter what you call it, right? This is a major problem. But the people who do this for a living, the IMF and other forecasters, still see a recovery next year in the US, right? So should that happen, we will not see a depression in the conventional sense, but the longer it takes, the less number of people will, be able to be re-employed because less number of firms will exist and demand will never fully recover.
Yeah, with 40 million people just in the United States out of work, and I can't remember the number that Barney referenced, but many more people globally out of work. It feels like outside of sort of the SME space and the large corporate space, that they figured out a way to continue to be productive while having fewer and fewer workers around. And
and the stimulus packages have been helping, right? So far, they've been keeping things afloat. I mean, I think, Paul Krugman calls it more sort of disaster relief rather than stimulus. That's a bit of a misnomer. It's keeping things sort of, from going under. And that's been helpful. But when that stops, things will get a lot worse. Yeah,
I agree. And I think both, from a corporate side, we can make a value judgment about whether those corporations who take stimulus from their national or federal governments should then be allowed to fire thousands of workers.
Right.
And then maybe use that money to buy back stock. But that's probably a political argument for a different time. But from a depression standpoint, if there is stimulus out there, whether it's regional, local, or global, I think we have to have a discussion about what is that stimulus money actually being used for as well. Yeah.
Absolutely. Yes, that's right. So while in lockdown, though, having stimulus is like pushing on a string, of course, right?
Yeah,
you can't revive an economy that's in lockdown. It doesn't have to be a lockdown. It's stringent social distancing measures, right? There's degrees of lockdown. Yeah. So the challenge, of course, is to remove those restrictions in a safe way and then get the economy going again. And that's when, you need the stimulus. Now it's just a holding pattern, right, to try and keep people alive and firms from sinking. But as you correctly point out, there should be greater oversight on how those monies, public monies, are being spent and whether they're serving the purpose they're intended for, right? And that's, I think, something that has become too politicized. And this is going to add to the debt that we will have to deal with going forward, and that's going to be a major issue when the dust settles, the debt overhang from these huge stimulus programs on borrowed money. Yeah,
agreed. And we're going to have to make a distinction between sort of government debt and individual debt because they're very different animals, as I know you understand.
Absolutely.
And the percentage of sort of public debt to private debt. We can talk about that later if we get Steve back online to sort of address that. I'd like to know if any one of the other panelists has any questions for Dr. Menon, and if not, we can move on to Paul's presentations. I can go on. I mean, I've got plenty more questions, but I'd like to see if the rest of the panel has anything that they would like to address. Hi, Paul.
Hi. There's a lot of good points that came out there, but I'd probably pick up on those talking
Please.
through some of the slides that I've got, if that's okay, and then we can
Go ahead.
connect them later maybe. So this whole issue, are we heading into a Great Depression 2.0? It's a fantastic question, and I think Dr. Giant did a great job of trying to answer it. But I actually think it's an impossible question to actually answer at this stage. One of the reasons, again, you both talked about semantics. One of the issues here is nomenclature. If you ask a history student when World War I started, most of them would probably say July 28th, 1914, because that's when Austria-Hungary declared war on Serbia. Some of them might say it was the 1st of August, which was when Germany mobilized and declared war, or 3rd of August, when Germany declared war on France, even the 4th of August, which was when Britain finally joined in and declared war. But actually, the term World War I wasn't used until June 1939. So
Right.
we didn't know that was World War I at the time. And in fact, there's a big argument as to whether it really was World War I, because there'd been at least six global conflagrations before that. So, whether this is global depression 2.0 is maybe partly a matter of branding. But if we look at the next slide, this is a note that I sent out to my clients in late February, and I was asking the question: is this what the start of the next depression would look like? I wasn't asking, is this the start of the next depression? I was saying, what would it look like? And I was trying to highlight two things: that in terms of capital markets, this probably is what Great Depression 2.0 would look like, but it's also what a lot of other capital market events would look like. So, there's no way you can infer from that whether this is the start or it isn't. And the other thing is that even, if this were potentially the start, that doesn't mean it ends up as Great Depression. A lot of outcomes are still being driven by, policy decisions. They're being driven by events. So, this is a potential depression, but it's only afterwards when we see where policy takes us, we see what happens, that we'll actually know whether this potential depression actually occurred, whether it actualized. And I suppose, one big worry is that question is in the hands of policymakers, as again, Michael and Dr. Jan touched on there. That is a concern. We can talk more detail about policy maybe amongst all of us later, but I don't know, I guess when Dr. Giant mentioned, it's not COVID, it's the economic damage it does. It made me wonder if Keynes were alive today, might he be writing a treatise called, the economic consequences of the pox? Because it's actually where this takes us. It's what policymakers do. And if we can maybe move on to the next slide. So, in one of the regular sort of TV appearances, Bloomberg's Youssef Gamal-Eldin, who I've got a huge amount of time for, incredibly bright guy. I don't know why he asks me questions. I think he knows more answers sometimes. Was asking me about all the revisions in S&P 500 forecasts, and everybody had started the year with a forecast, and they changed it, and they seem to be changing it on a daily basis. And my point was, you know what, I had no idea. And in reality, all these other people who are changing their forecasts have no idea either. You have to remember, back in the Great Depression, in the spring of 1930, everybody was saying, "Hey, this is all okay. It's all fixed now. It's all great." And as we know, all too well, actually, it wasn't. So, for anybody who's ever seen it, there's a biopic about Patsy Cline called Sweet Dreams, and the film ends with a scene when they're in a light aircraft, and they're all laughing almost hysterically because they've just avoided a very near miss. And at the point they're laughing, the plane then flies into a mountain and they all die horribly. So, we never quite know what is ahead of us, and it's not always what we think it is. It's not what it looks like. In which case, how can we try and answer this question about, is this GD 2.0? The best thing we can actually do is have a look at the conditions and see what could happen, see what the risks potentially are. So if we could look at the next slide, one area that we've looked at is world trade. Now, WTO, who again have probably a better insight on world trade, but they don't have a better crystal ball than anyone else, have said they expect world trade to fall between 13 and 32% this year due to COVID disruption. That's obviously pretty significant, but what we need to keep sight of is that actually world trade has been struggling since before the global financial crisis, both in absolute terms, but also in terms of its relative importance. For instance, if we look at it as a factor of GDP, we look at it relative to the size of GDP growth. So, I would say that the world has actually been changing for quite a long time already, and that we're reaping some of the consequences of that. And in my view, the number of factors, obviously a very complicated area. We can talk about it some more later if people want to delve deeper. But in my view, one of the biggest issues is just the sheer financialization of the global economy. And I think there's probably no better example of that than if we look at Tesla trading at a 1,000 times price earnings ratio. One of the other key factors in a depression, as opposed to just a normal cyclical recession, is the sheer level of debt. And again, I know you drew this distinction, Michael, quite rightly. Private debt is the really important factor. And going into the COVID situation, we saw pretty extreme levels of private debt. Now, the reason private debt is so important is it's probably the single most important driving factor of GDP growth, economic activity growth. So it's the correlation between change in the rate of increase of private debt and change in the rate of economic activity is one of the strongest correlations that there is. We'd already seen that actually there weren't that many places that were able to keep sustainably increasing their debt levels because debt levels had grown so high. In fact, if you look on the private debt to GDP chart there, if you can see the kind of small print, the three highest rate of change jurisdictions, economies, were Greece, which is a wonderful place, but it's maybe not systemically important. That was the biggest one. But the second and third were Hong Kong and China, and together, they are systemically important to growth. And so, and again, I think that's borne out by Dr. Giant's slide, where we saw that China was meant to be the sort of great hope for the global economy. Well, it would need to keep increasing the rate of private debt increase in order to keep growing faster, and that I think is a really big question that COVID has asked. Just to pick up again on one thing that you mentioned in the conversation you were having, Michael and Dr. Giant, this issue about the importance of the US to the global economy absolutely can't be understated. But I think one thing we need to bear in mind is it isn't just about the US consumer. US consumption is a really significant driver of global economic activity, but even more important in the world that we live in today, in the global economy that we live in today, is the footprint of US financialization. So because we live in such a financialized economy, because so much of that is generated by the United States, that really is a huge threat to where we might be going here. If we could just take a look at the next slide. One one thing that stems from the huge increase that we've seen in private debt is distribution of income, wealth, and debt. And again, Dr. Giant touched on, the social issues with this. I'm sure he knows way more about that than I ever would. But my primary concern beyond social, is that this is also a functional economic issue. That when we get to levels of private debt that we have today, the distribution also becomes a huge problem. The marginal consumer is frankly tapped out, and so this starts to become a huge economic headwind in that case. And if we could just move on to the next slide. So what do we expect? We expect that policymakers will try to respond to this. We've seen that they've already responded. They've responded in a scale that is unprecedented, but it could very well get dwarfed by the kind of responses that we see in future. And actually, they're the only ones who can really answer whether we're headed for Great Depression 2.0, because a lot of it is going to really depend on what they do in this situation. It pretty much all comes down to them. Again, I know that obviously Michael and Jan, you both talked about this, but this is probably the single biggest factor here. And the last thing I'd say is that for some reason it seems that way too many policymakers are men, and maybe that's the reason why that a lot of policymakers seem to have decided that size is the only thing that matters. Maybe they've been told that. But I think that's probably as much as I've got to say for now.
So I've got a couple of questions. I want a little bit of a deeper explanation, because something you said was, a lot of the things you said are actually very interesting. But you said world trade itself does not exactly contribute as much to GDP growth as most people think. And I'd like to understand that a little bit more based on some of the data that you've shown. And then the second thing, just so I don't forget, is just an explanation about what you mean about this sort of financialization of the global economy and how that's driven from the United States, because some of the people that are listening may not exactly understand what that means. Yeah. So why don't you do the first one first and the second one second? Yeah.
Well, those two things are actually related.
I know they are.
So what we've seen is that historically the economy was driven by people making things, people buying and selling things. Now that's become a smaller part of what actually drives global economic activity. Obviously, yes, the services side has become important, but the really dominating aspect of that is what we call financialization. So the fact that so much of global profit emanates from activities like banking, like investment, activities that don't have necessarily the same productive input back into the economy as manufacturing did. So it's a very different economy these days, and the key drivers are banks being able to lend, brokerages being able to trade, all these things that you would think that bank lending, obviously because it increases private debt, should be a positive input into the economy. The problem is that when economies become so global, so financialized, we end up with a much lower productivity, a much lower rate of return, productive return on the lending. If you look at charts of things like zombie companies, for instance, the amount of zombie companies, particularly in the States, which is the sort of epicenter of financialization, the amount of zombie companies that are only able to exist because they're able to finance their operations, they can't survive on operating cash flow anymore. It's become almost parabolic. So people talk about we have this disconnect between the Wall Street and Main Street, and I'm sure everybody's sort of getting bored about hearing about this. The thing we'd say about that is yes, of course we do. If you look at what's happened with stimulus, we had a situation where the global economy started to slow, the US economy started to slow. You look at what's happened with stimulus, There's something like $50,000 per man, woman, and child in the US that's been created by the US government as stimulus packages, but only about 2.4% of that seems to have gone to consumers. Most of it, people. Yeah, people don't get it.
Real people.
Exactly. If the money doesn't go into the real economy and it's going somewhere, well, it's obviously going into capital markets. It's going into asset prices. So
right. So I want to just interrupt you for a second, because I want people to understand the fallacy of these stimulus packages, right? And that is that the U.S. government is pumping, pick a number, $2 trillion, $3 trillion into the economy. But the reality is, and you said this, but I want to say it more explicitly, is that it goes into companies as opposed to people. Those companies then take that money with no restriction, right, and then potentially put it in, because how are most of the senior management compensated? They're compensated with their either stock or options ownership. And what happens to that money? Well, the best way for them to make money without paying themselves directly is to buy back stock. Exactly. Because particularly when the stock market goes down in a way that you said, maybe parabolically, but definitely 30, 40%, it's just a massive win for them to bring, and this is one of the things that you talked about at the beginning of this presentation, is you bring the S&P, you bring the NASDAQ, you bring the New York Stock Exchange, the Dow Industrials higher. Now you don't care.
Exactly.
Because that stimulus doesn't go to people. Yeah, that's financialization of the, but I wanted to be explicit about what that actually
is. And I think, Michael, just to pick up on that point, you have to remember, people say, well, so if this money's not going to people, it's going to companies. It is, but it's actually, ending up flowing towards a very few companies. It's not going to small businesses that need it. The small business loan take-up has been minimal. It's not even going to, listed companies that are generally in trouble. There was some pretend kind of accommodation for that. Most of this money is basically going into FANGs. One way or another, it's ending up going into, what they now call the S&P 5, which are the businesses that have gone up this year on the stock market, as opposed to the 495 that haven't.
Exactly. Look, let's, I have so many more questions, but I think what we want to do is we want to get to the next presentation. We want to let Steve come back in. So thank you very much for doing that. And then maybe when everybody's presentation is done, we'll come back, and I have so many more questions. And I think the panel has more questions as well. But that was really interesting, and a lot of stuff will come out of that too. Steve, are you ready to jump in and give your presentation as well?
Sorry about my internet hassles earlier. I'll be partly amplifying some of Paul's points there.
I'm sure.
Because in one sense, what Paul and I focus on that mainstream economists ignore is the role of private debt in the economy. And Paul's given recent data on that. I want to show American data going back to 1834, which of course is pretty much as far back as you can go in American capitalism. And the red line shows the level of private debt compared to GDP. The blue line is the annual change in debt, which is credit. And this is left out of conventional economic thinking. It's a travesty that it is, but mainstream economists like, for example, Paul Krugman, prefer to play with a model of banking which pretends that banks are intermediaries when banks actually originate money and debt. And by so doing, when debt is growing, credit demand is added to aggregate demand. When debt is falling, credit demand is subtracted. Now, if you take a look at the three major downturns in America's history, they're all periods of negative credit. So the blue line there is showing the annual change in private debt divided by GDP. You can see the Great Depression. We all know about that. You can see the Great Recession. We also experienced that, most of us. What most of us don't realize is way back in 1837, there was a similar crisis called the Panic of 1837. And that's what's highlighted over here with that this particular downturn here. All of them, these major downturns, are credit downturns. Now, we look where we're starting from right now at a level of private debt. Even after a bit of deleveraging after the Great Recession, the ratio of debt to GDP is still higher than the worst level achieved during the Great Depression. So we're starting with a debt-encumbered society going into the COVID crisis in the first place. We should have got rid of that debt. We haven't done it, so we have two problems at once. Now, normally, some governments, thankfully, have thrown large amounts of money at the economy right now to avoid the downturn caused by COVID. But the panic is, how are we going to pay for it? Well, nobody was afraid of government debt during the Second World War, and I want to show government debt now and showed us how high that was after the Second World War began. When you go back to the beginning of the crisis, it was about the beginning of the Second World War, pardon me, you had a debt level of about 30% of GDP. That exploded to 110% of GDP during the war itself. And at one point, the change in government debt in 1 year was 30% of GDP, which is huge. But having reached this enormous level of government debt to GDP, it fell all the way through the 50s and 60s and 70s, while at the same time the government was still running deficits. Now, that is something which conventional thinking can't understand. And the reason this is not the usual problem that people see government debt as being is debt is something you borrow from somebody else, and that's normally a bank. The government's debt, on the other hand, is an asset swap for banks from the reserves that the deficit itself creates. When the government spends money, it puts money in private bank accounts, and it simultaneously increases the assets of the banking sector through adding reserves. So the money, the deficit itself creates additional money in private bank accounts, and it's matched dollar for dollar by the increase in reserves that are on the banking sector's books.
To help just to help some of the listeners, can you define what an asset swap is? We know this, like I've been in the asset swap, like I understand that, but I want people that don't necessarily understand that.
I'm showing a table which I hope will be more straightforward. Please. The actual action of spending and if you spend more than you tax, that's what I'm showing in this little example here, then you increase the amount of money in private bank accounts. That is actually creating money which turns up in the reserve accounts of the banks. So the banks themselves receive the reserves, which has been created by the additional spending. If the Treasury then sells bonds to the banks, the banks reduce their reserves and increase the holdings of bonds. Right. And what is happening for the banks is the money has already been created by the government spending. It's sitting in an account, the reserve account, which they get paid no interest in. The Treasury then offers them bonds which pay interest. You'd have to be an idiot bank not to take the offer. So the money that's needed to pay for the bonds is actually created by the deficit itself. There is no difficulty in paying for government bonds in a country which issues its own currency, like Thailand, like Malaysia, and so on, not like the European Union. So there's no difficulty in financing that debt. The money is created by the deficit itself. And that's the error in people's thinking. They're terrified about the future impact of the deficits now. The deficits themselves have created the money that's going to pay for the bonds that will be bought by the financial sector. There is no possibility of them not being paid for.
Isn't that the Japanese story?
Yeah, the Japanese have been doing it indefinitely. They haven't addressed their private debt problem. Yeah, 25 years. They haven't addressed their private debt problem. That's the major hassle. They've let their private debt remain extremely high. We're really worrying about the wrong thing, the government debt. We should be focusing on getting down the private debt. So that's the overall background. There's no problem about running the deficits for COVID right now. We have to do it. Now, I want to put COVID in context because we've taken our eye off the ball of climate change. And while that's happening, some people who argue that climate change is just a false alarm are making cases like this. This is Jon Longborg. And notice he's saying that climate change will only mean that incomes, rather than being 450% higher than they are now, will be 434% higher. So it's not a major problem. And this sort of stuff is getting coverage in the media right now. I want to dive behind where these sorts of claims are coming from, saying that climate change will only cost us 3.6% of global GDP by 2100. Where does it come from? It comes from work done by William Nordhaus. And this is the worst work I've seen in my history of critiquing bad work in economics. Nordhaus.
It's also 30 years old, right?
Pardon?
It's also 30 years old, right?
Yeah, but it hasn't been changed. 2014, they say.
I understand that. I just want to make the point.
They haven't grown up. This is Nordhaus back in 1991 saying 87% of industry is not going to be affected by climate change. What does that 87% consist of? All manufacturing, all mining, all transport and communication that's not on waterways, finance and insurance and non-coastal real estate, retail trade, government services. He simply assumes that won't be affected. That is just nonsense. We've been lulled into a false sense of security by claims like that. We've massively overshot what our economies can sustain on the biosphere. We're going to see a massive contraction in output in the next 2 to 3 decades, and COVID is just going to be a picnic by comparison. This paper coming by me recently in about another 1 or 2 weeks that should be publishable, will show just how bad the data is that we're relying upon. So my bottom line is, if you're worried about COVID, brace yourself what's going to come next, because COVID's going to look like a picnic compared to what's going to happen with climate change in general.
Yeah, I mean, I've got 1,000 questions. Are you finished?
I finished, yeah. I'll just actually stop sharing my screen.
Okay. Yeah, I mean, I don't even know where to start. So climate change, obviously, we've been through the presentation. Climate change is going to have a massive impact, and whether you're a climate believer or a climate denier, you can't deny is that it's going to have a massive impact on economic stability. You've done some things. So one of the things that you were introduced is you have this thing called the Minsky Project. I forget the name of it, actually.
Yeah.
No, go ahead.
Yeah, Minsky is the sort of tool that economists should have been using for the last half century to model the economy as a dynamic non-equilibrium system. And they haven't. They've stuck with their equilibrium models. That's the same sort of nonsense that underlies William Nordhaus's DICE model, presuming we're always in equilibrium. I wouldn't call the wildfires in California an equilibrium event. But according to an economic model, you can ignore those, because once it's all over, the trees will be in a new location. And you don't need to worry about the transition. That is obvious garbage in the situation we're in right now.
Do you want to sort of, what's the right word? Do you want to talk a little bit about Hyman Minsky's financial instability hypothesis and how it impacts this in a little bit more detail, and try to talk about how that impacts your view on whether we are in or coming into a depression? I mean, you said COVID is just sort of like the appetizer to a much more difficult, it's going to make it look like a picnic, you said, in relation to what's coming because of climate change and the impact that that's going to have on the economy. And this was an unintended conversation for me, but it's fascinating to me. And I think it's really important for people to have it. In the context of this, I think, you tell me where I'm wrong, but I think that COVID, because it literally put a stop on the world for like 2 or 3 months, which I think is, in a way, kind of awesome, where everybody just kind of went home for a while and said, what are we doing? What kind of world are we living in? What kind of world do we want to live in? It's given people pause. And during that pause, again, we've seen economic destruction writ large, not just in the United States, but across the world. I think that Dr. Menon mentioned this. In the poorest countries, it's been some of the hardest. In the richest countries, it's also been hard. I know people are telling me to stop, but I can't. Can you explain how this Minsky stuff then correlates into your view on whether there's going to be a depression, and how that correlates to the climate change stuff as well?
Okay. Well, to start with the total lack of preparedness we had for COVID, it isn't just Donald Trump who's responsible for that. Economists have got a very sanguine attitude about what they call the incredible flexibility of modern economies. And again, to quote an old paper, but a relevant one, by William Nordhaus, who surveyed so-called experts on climate change, 8 of whom were not experts. They were economists like Larry Summers, who's only an expert on making smart-ass comments, not an expert on climate change whatsoever. But they were saying that they thought, because of the incredible adaptability of human economies, the impact of climate change would essentially be zero. Now, what we're going through is not zero. It's about -30% if we're lucky. And this is just a warm to show how delusional they were in ignoring the actual dynamics of a capitalist economy, and how by focusing upon efficiency, we've ignored resilience. And we don't have resilience built into our economies. So we have to consider now forget about efficiency, make economies resilient and capable of withstanding huge disturbances, not just like COVID, but also as in the change that we're seeing in climate change right now. That means a dramatic shift away from coal-based and oil-based energy systems towards renewable and nuclear. We have to make that change dramatically. And because we have a naive belief the economy is inherently stable, that's why we end up with these delusional people running policy who leave us completely unprepared for crises like this. In terms of how Minsky fits in, my Minsky analysis really is saying capitalism is an unstable financial system, and you have to think about it that way. And the simple thing behind Minsky is, first of all, banks create money when they lend, and that additional spending power boosts the overall economy. What you will have is a very simple way to explain it. If you have a period of boom, capitalists justifiably going to want to invest more than they've got in retained earnings. So they borrow money to do that. The extra borrowed money drives the economy into a hyper boom. Then you have wage demands, changes in income distribution, higher prices for commodities coming through because the economy is in a boom. That cuts into profit margins and means at the peak of the boom, capitalists aren't making the profits they thought they were making. They start cut back on expenditure and investment, and you fall back down again. You go into a slump when they try to repay debt. And what you have is a ratcheting up process where a boom leads to taking on more debt. Then you go into a slump and you pay off the debt, but because the economy is slumping, you don't pay quite all of it off. So it goes up for another ratcheting up and another ratcheting up, another ratcheting up. And through that process, you will finally get to a level of debt which can't be serviced when the next downturn comes, because workers whose wage rises have fallen because of the increase in debt can't cut wages any further. You're still paying compound interest to the banks. You get an overtaking and you have a collapse coming out of it. That's what led me to anticipate the 2007 crisis.
Right.
The solution is to reduce the level of private debt, which would be straightforward to do given government money creation capability, as we've seen with quantitative easing. But again, because our politicians are more interested in rescuing the financial sector than the real economy, they haven't done it. They don't have the mechanisms for it. So as well as having an economy which 30% of its productive capacity has been smashed by COVID, we're carrying a level of private debt which is, in terms of relation to GDP, 3 times as high as it was back at the time of the Spanish flu. So,
right. Is there, again, I'm being told to let you go, but I have another question, and I'm not going to let this go. But we'll get back to some other people's questions in a second. But is there a grift element in this, in the sense that the reason why financial companies get bailed out and why other large corporations get bailed out is because there's a financial incentive for the people that are doing it? In other words, is grift, and I won't say graft, but is grift involved in the sense that if I bail you out, I think you understand what I'm saying.
There is a bit of that, but fundamentally, the economists who run central banks are naive believers in conventional economic theory. So they simply believe that their little tools work. And secondly, the central bank, which is the conduit to all this, doesn't have a way of putting money in private bank accounts.
They don't, but the federal governments do. And
federal governments do, that's right. So
right.
we need to get the Treasury's agreement to put the money in private bank accounts. And that's what the struggle has been. What's one reason I support the formation of what are called central bank digital currencies, because if that was done, everybody who was a national of a country would have a central bank digital currency account. And then that could be used to make direct transfers to the public and bypass the financial sector. And that's
I mean, if
doing.
You're suggesting that there should be some distributed ledger technology that's associated with creating a digital currency for every country, which would then give everybody a digital wallet, which would be immutable and unchangeable and trackable completely. It would mean that instead of writing a check to somebody that was signed by some random person, you could just immediately transfer money or spending power into individual accounts in a way that was instantaneous. Well,
yeah,
okay,
I'm adding one curly to that proposal. This is something which is, like you say, you could put actual money inside those accounts, and you could track how much was put in and so on. You could also specify what it was used to do, which would be
sure, because you could write a smart contract for what that could actually be used to buy. In other words, if you really want to get moralistic about it, you could say these assets that are put into your account cannot be used to buy alcohol and drugs. They can only be used to buy food and pay rent, right? So that's not that hard to do.
Yeah, but you could also set it up and say, we're not giving you money, we're giving what I call universal carbon credits.
Yeah, same thing. Thing.
And then you could say every commodity must have 2 prices, a dollar price and a universal carbon credit price. And then set up the ration for universal carbon credit so that average people don't access all their credit. But the rich do. So the rich would need to buy the credits off the poor. And that's
absolutely.
I think that's another thing we need to consider for the future.
Let's get back to that. Don't lose that. I want to come back to that, but let's go to Jack and let's finish off the presentation section of this, and then we'll come back to this conversation.
I mean, that's tough to follow there, Michael. So I'd like to thank everybody for what they've said. I'm going to whiz through this because I can see these questions coming through, and I know you want to generate a discussion on it. Look, when I look at what's happening in the world, I look at it from an investment point of view because that's my job. I will comment on some of the things that Mr. Gamble said, where he said, we can't tell if we're in a Great Depression, like we didn't know we were in World War One till a long time after it. But Dr. Menon's presentation also rang to me. I'll answer it in two parts. I don't think we're in a Great Depression. I think we're starting to see what we knew in March and what we now know is very different. I point to signs like China reopening, which I believe is the single biggest driver of global economic growth in the world now, greater than the US, although the US is a big part. We're seeing reopenings with some rolling shutdowns around the world. But I think we're on the road to recovery. Now, whether that recovery is what we saw pre-COVID in 21 or 22, is another question. But I do really believe we're on the road to recovery. And what we know about the virus is different to what we knew in March. We're treating it differently. We're told that mask wearing, social distancing, hand sanitizing will bring the rate down. And I can see that around me and around the world happening. And we're getting, better at how to treat it. And I also think we're going to see some therapeutics out by the end of the year. I point to a few that are coming through, particularly a Merck drug that I think is very promising that's in phase 3. And I'm an optimist that believe that we're going to see a vaccine, possibly not by November like we hear, but in the first quarter or second quarter of 2021. I think the point that I just wanted to bring up, and I'll just go to the next slide. I think I'm doing these, sorry. Is what we're going to see out of COVID-19, and I think what you're seeing is a re-acceleration or acceleration of trends that we saw previously. And one of those is economic regionalism. So I think the world economy is starting to be split up into 3 parts. I think America with North America and the USMCC, we saw that pre-COVID. I think that's accelerating. Europe in its own bosom under the European Union and the euro dollar, and then Asia, which I think is the center of global growth around the world and is going to drive global growth over the next 40 to 50 years in the bosom of China. And then some of the acceleration of trends we're seeing already, and that's because of reduction of supply lines. So that's going to lead to more economic regionalism, but also lead to an acceleration of things like robotics and automation, 3D printing, in terms of bringing supply lines back locally. Now, the question that brings up is, does it remove more jobs than it creates, and therefore, worsen the unemployment rate that we're seeing in front of us? But from an investment point of view, in terms of managing money, this is where I'm looking for. And then the other big question this brings up is that what we've seen around the world is how big can some of these big companies get? And Mr. Gamble's commented on the S&P 500 and what's driving growth around the world. Amazon, Apple is now a $2 trillion company. Amazon is well on its way. We talk about the Chinese giants like Meishuan Jiangping, Tencent, Alibaba, all merging towards 500, 600 billion market caps, becoming big employers, or some of the largest. Amazon is now the second largest employer in the US. What effect do they not have, not only on the trends or the services that they give us, but on policymaking? And I think the US is a perfect example. The companies led, mask wearing and the way we virus. So there's some interesting questions of what we come out of and what the global economy looks like and what consumer trends look like and how we start to interact with each other. So they were the 3 major points that I want to look at. And the last one in terms of how big can these companies get, and they look like they're only going to get bigger and bigger. So I'm sure you're going to ask me a follow-up question on it, Michael, but that's where I was coming from in terms of perspective, but there were some great things that were brought up by everybody else.
Yeah, I mean, one of the points that I want to make, and what I really want to do is open the floor to questions from viewers, but also I want to have an interactive sort of questioning from guest to guest. But I will say this about my view on the size of these companies today. We could have made the same argument for, Standard Oil, or for Exxon, or for General Electric, or for IBM at the height of their power. I think the reality is that if you're, as you are, if you're like a student of history and you watch this stuff, it's all cyclical. There was no way you could have predicted that Facebook would be more powerful than Microsoft, or that Apple could come back from 1997 and be the first $2 trillion company when, Dell famously said, what would you do if you owned Apple? It'd be like sell it for parts, basically, or give the money back to shareholders. So I think it's hard to predict like what any individual company will do with its power. But I do think that this economic regionalism that you're talking about is actually an important point. And we do have some questions surrounding this, one of which, and I'd like to get everybody back in, if that's okay. Can we do that from a production standpoint? We do have questions from people asking, in particular, what if parts of the world are willing to do the things that are necessary to sort of fix some of the endemic and inherent problems in the global economy, and other parts of the world aren't, particularly in the context of what Jack is saying, where you're creating these regionalistic economies. Now, the elephant in the room, I think at some level, is One Belt, One Road. So China is trying to, reintegrate the world economy based on its currency and its economy, as opposed to what we've had for the past, I don't know, pick a number, 100 years. Right? We can make an argument about whether the American century is over or not. I don't want to get that political about this, but I guess the real question is, and I do want to get back to some of the stuff that Steve was talking about as well, but what do we do if there are parts of the world that are willing to change and other parts of the world that aren't? And maybe we start with you, Dr.
Me?
Yeah.
Yeah, okay, right. No, I really enjoyed listening to Jack there with the impacts that he sees to supply chains and so on. And I think the first point I want to make is how, we should recognize that, COVID has accelerated some underlying existing trends, right? They didn't start with COVID, they may not end with COVID, but basically it's an accelerator, I think, more than anything else. I mean, a lot of the restructuring to supply chains have already been in place before the pandemic, or the lockdowns rather, came into play. And so we should recognize that for what it is, right? That we can't, it's human nature to try and attribute everything that we see to the most recent shock, but we should try and resist that temptation as far as possible. And the world too has been fragmenting, I think, into regional blocks for some time now, and this is tied in with weakening of multilateral system. The WTO has been losing its influence for quite some time. This might, be the straw now. Who knows? But one way I think we can go forward from here is recognize that there's multipolarity as some kind of new equilibrium, a new disequilibrium that we live in, and find ways in which we can link the different regional blocks together. That's how we might have a more, a more resilient or less sort of chaotic future. The ideas of bringing back multilateralism, I think, may be too much of an art right now. We have a world that's very unhappy with the negative consequences of globalization. And so the appetite for return to the old normal is not there. But there are intermediary steps. This world, multipolar world, where we, have regional groups that do many things together as smaller in smaller units, but find ways of linking those groups together. I think that's where we can go from here. And COVID has basically accelerated that thrust, I think. Yeah.
Interesting. Paul, do you want to go back to your question on Nordhaus to Steve?
Yeah, sure. I mean, before I do quickly, just picking up on that point, I think the problem with multipolarities is, there's a phrase in Thailand that when two elephants fight, it's the ants that get squashed. And I think that actually is the biggest problem we've got with multipolarity at the moment. The American century is going to change, but I don't think way it can be over just yet, because we have this massive global financial system, and dollar is the only currency that can be produced in sufficient amounts to satisfy that system at the moment. So I think that's the transition, and that's multi-decadal, I would imagine.
Can I interrupt you for a second? Because this is recent news. You have the current administration in the United States trying to remove the ability for countries that are dealing with China, or China itself, from dealing with SWIFT. And the SWIFT system is the way that most banks and most countries transfer money around the world. We know that the dollar is the global reserve currency, but it's also the currency. The reason why it's not the only reason is because of oil, right? So all the commodities in the world trade in oil. It's not the only reason, but I'm just wondering, if we go to a system that Steve has talked about where every currency is now a digital currency, so the ability to create it and also the ability to move it around the world is seamless and frictionless, what does that do to the dollar as the reserve currency and as the only currency that can be created to do all this stuff? It's an interesting concept, right?
Totally, yeah, and that could be a huge accelerant to this whole transition process that we're talking about. In which case, I think there's an awful lot of ants that are going to get squashed by those two elephants fighting. It's hard to see how we end up getting there in a in an orderly way, shall we say?
Well,
one thing I think I mean, just going back.
Go ahead, Steve.
In terms of ants and getting squashed, I think one element, let's not forget, one of the elephants has degraded its own body for the last 40 years. That's the American elephant, by basically pushing globalization, because it meant they could replace expensive American workers with cheap Asian ones. But the long-term consequence of that, of course, they don't have skilled workers in America anymore who can handle machine tools and so on. You have a much higher skill level now in Asia for manufacturing and engineering in general. Of course, there are dramatic exceptions like Tesla and SpaceX and so on, where Americans can show what they can do when they devote those resources domestically. But in terms of a wide swathe of production, I think Asia is actually in a better situation to be one of the ants that goes it alone while these two elephants fight. We're likely to see the consequences of 40 years of globalization backfiring on America and Europe, but America in particular, compared to Asia.
One of the elephants is Asian as well. Let's not forget.
That's true. But I think what China is doing is showing how dramatically it can expand its territory by using its own monetary power, as well as its fiscal power, and a focus upon developing its own technology, courtesy of stealing it from the Americans in the first place and then beating the Americans at their own game. They now have a manufacturing capability which exceeds their consumption capability. Not necessarily a bad thing, because I think British consumption is going to have to go backwards. But they can make almost everything they need domestically now. They don't need the Americans. Whereas Americans, of course, need them even to produce face masks and surgical equipment. They need the Chinese. So COVID is really dramatically accelerating that imbalance as well.
So can we put a little... Sorry, Paul.
I totally agree with that. What I was just going to say quickly was picking up on Jack's point about how big can these companies get. The biggest threat to Amazon and to Apple is actually the American government itself. The two limits to how big a company can get. One is competition, and the other is regulation. And regulation is actually just competition that comes from the government. And if you've got multinational competition, you've got various governments lined up against you, then that gets even harder still. So I think that whole dynamic of multipolarity is actually potentially very, very bad for some of these big companies. Sorry, Michael. Sorry.
No. I just wanted to make a point that this idea of technology stealing has been going on forever, right? I mean, if you go back and look at Japan's coming out of World War II, I wouldn't say they necessarily stole technology, but there was definitely a technology transfer between the United States and Japan, which then led to not only, but helped lead to Japan's economic ascendancy and technological ascendancy in the 60s, 70s, and 80s. And sure, we can argue about whether China stole technology from the United States as well, but this has been going on historically forever. I want to take a question from the audience, so let me lean in and actually read this. I'm going to read this directly. Given that we're more globalized, and I'll leave this to the panel to decide who should answer it, compared to 1929, right? We talked about this earlier, where the free flow of information was much harder back then. Will it be more a regional or a global issue in terms of finance and depression and economic and social shift, or will it be global as well? Steve?
I think we are far more globalized now than we were back in 1929. Production chains didn't involve 20 countries. They might involve 20 companies back in 1929, not 20 countries.
Fair
we
enough.
know the Apple iPhone's got about 100 countries involved to some extent. I think what we're seeing is that countries which have followed more of a self-sufficiency capability, whether that's low level like North Korea or high level like China, where they try to become a manufacturing giant for the entire planet, they're going to succeed better than the ones that went for specialization. countries like Australia, for example, which now has a lower level of industrial complexity than the Seychelles, they're going to have to struggle to try to build any productive capability whatsoever. Asia's question is going to be to reorient what it's currently got from exports to domestic consumption and from coal-based power to solar and nuclear power. But they've actually got a base to start doing that transition from. So I think it's going to be, we're going to see the impact of becoming too attuned to the previous climate in which you could have low-cost global supply chains. Countries that relied upon that, like America, are going to do very badly. Countries that were supplying the supply may do comparatively better.
Yeah, so you've led to my next question, actually, and that is this idea of, if the U.S. is benefiting from relatively cheaper inputs from China, whether it's the entire electronic supply chain in Shenzhen or other supply chains that exist in China and Vietnam and the rest of Southeast Asia, as you said earlier, the U.S. has benefited from globalization by exporting that supply chain and also exporting expertise to the rest of the world. What's going to happen if what Jack says is actually already happening? And maybe, Jack, you can comment on this as well. If these economies regionalize, so Europe is a uniquely European economy, including Eastern Europe. Asia is a Chinese-based economy, and the US is North American, or an American, maybe North and South American economy. The input prices for goods produced in the US is going to be much higher by definition, particularly if for no other reason than because people are going to have to be retrained, and then the entire supply chain is going to need to be recreated. I mean, Jack, what's your view on that?
Yeah, I mean, this whole multipolar, I think we saw that trend. I think this is going to accelerate trends. I think we bring supply lines back to your localized region. Now, they may, in the short term, increase input prices, but there's just one factor that pushes prices down around the world everywhere, and that's technology. You know, we talk about 3D printing, we talk about robotics, we talk about automation. You know, that will do that. And I think we saw that pre-COVID, and I think there are some benefits to multipolar. You know, you play tennis against good players, you get better. And Michael, you asked the question about how we treat the virus, or how different regions treat it, and what do other regions do in response. I think you look towards the better solution, or, you know, the better response, and you start to copy it and improve upon it. So, well, you know, we talk about inflation around the world and why we don't have it, or, you know, argument against it, and that's because of technology. And I think we're just going to see an acceleration of that. And Professor Keane, who's way smarter than me, you know, he talks about efficiency and resilience. I still believe there is some element of resilience, and I know you do too, Professor, in terms of getting on with things and moving on. And one of those supply inputs will be because of that. So, yeah, interesting times.
Can I just say,
please.
Yeah, I think you can have a world that's increasingly multipolar that's still globalized, right? These are not necessarily mutually exclusive or choices. It's just that power shifts will occur, and there is some level of deglobalization already taking place and has been for a while. If you look at supply chains, they've started, the amount of trade associated with supply, they've been falling for a bit, as trade been falling for a while before the COVID crisis hit. So these things are not either or. I mean, they can happen consistently, and also I think we shouldn't give up on globalization. I mean, there are parts of supply chains that will reshore, nearshore, and so on. But there are other bits that are quite resilient already, right? And will continue. And technology is changing all the time. So the ways in which we do things will continue to change, right? So we can't just assume that the current state of the art is what will determine the future as we go forward. And finally, though, let me just finish by saying, I think, there's also a tendency to blame this whole pandemic on globalization. I think globalization may have contributed to the speed at which the pandemic spread. That's true because we are so interconnected, but it didn't produce the virus necessarily. I mean, you could have a very broad picture of how all our behavior needs to change to reduce the risk to these sorts of outbreaks, and I can agree with that. But I think the globalization will also help us overcome this pandemic as well, right? The spread of ideas, the sharing of information, and so on will also help in how quickly we overcome it. So let me stop there. Yeah,
Steve, you were
and I
saying.
think Steve wanted to say, yeah.
Yeah. Well, I think we often use technology as a magic wand in economics. And I want to bring the magic wand down to slightly closer to ground. What do we mean by technology? What we normally mean is a way of applying more energy to a particular process that was possible in the past. That's why we could hop on planes and fly, 12-hour journeys versus what used to be 12-day journeys. It's the higher energy consumption.
Well, some people will say lower energy consumption, actually, but per unit of output.
No.
Yeah, all right. That's a different debate. Yeah.
Okay, you use more of your own personal energy to do the old-fashioned journeys. These days, you use the energy of burning carbon-based fuels. Because we haven't properly prepared for the energy crunch we face in terms of not being able to use carbon-based energy in future, we're likely to see a dramatic reversal of what we've called technology in the past. We have to find ways to reduce the amount of energy we're using because we don't have the capacity to produce that energy without producing excess carbon dioxide at the same time. So I think technology is a double-edged sword. If you can't use that energy anymore, then what you've depended upon to do with that energy ceases being possible until you can find ways to replace that energy input.
Yeah, so and I want to ask.
So Steve, my question to you earlier was going to be, so, your friend Nordhaus says that 90% of economic activity is going to be largely unaffected by climate change because it either happens indoors or it happens underground or it happens in some kind of vehicle. So therefore it's immune from climate change effect. If we look at COVID as being an early stage symptom of environmental change, which of these do you think is likelier? Nordhaus is asked to give back his Nobel Prize that he got for that 90% of it is okay theory, or he'll actually change his mind and admit it's complete rubbish, or is there some way that people will actually reject this and wake up?
So can I just jump in for a second? I think Nordhaus is never going to give back his Nobel Prize. I also think the idea that 90% of economic activity happens indoors is, what do we call it? It's a red herring in the sense that, so if the polar ice cap melts and you're indoors, you're still going to drown. Anyway, Steve, please go ahead.
Yeah, I mean, Nordhaus, I don't think he can have your Nobel, but I think he should have a second ceremony involving, I think we should hold it at a place like Nuremberg, which would be fairly appropriate, frankly.
Ouch.
Because I think it's going to be far more people die because of his criminal negligence, frankly, on climate change than when we lost in 1939 to 45. Yes, we have completely fooled ourselves about the impact of climate change by trusting economists on this. And I mean, I'm a critic of mainstream economics. I've never read garbage as bad as this of any other bunch of economists in the last 50 years, literally assuming that anything which is done indoors won't be affected by climate change, even pretending that the current impact of weather on GDP can be used as a proxy for what climate change will do. So because Albuquerque's 10 degrees warmer than New York and has a 5% lower GDP, therefore increased global temperature by 10 degrees and will cause GDP to fall by 5%. It is literally that simplistic. Now, once we realize how totally delusional that is, we're going to have to go massively in reverse on a whole range of policies we've been going forward for the last 50 years minimum. And that's what scares me. We're not ready for it, and COVID shows how unprepared we are for it. Again, the confidence of mainstream economists that the economy is flexible enough to cope with any shock so that the impact will be essentially zero. This is no zero we're talking about right now. So I want people to wake up to just how serious the threats are that we face.
Yeah, and I also want to make the case that saying that nothing that happens in climate change will affect anything that happens indoors is like saying that nothing that happens at night impacts what happens during the day. I want to ask another question, everybody, and then maybe we should stop. But we spent a lot of time talking about technological change, right? Whether it's the use of energy or automation or artificial intelligence or machine learning. But I think the impact of this, and we also spent a lot of time talking about acceleration, how whatever we're experiencing right now, whether it's, the fourth industrial revolution, you can call it whatever you want, really. I'm not so held back by semantics. But if we're talking about the impact that all this is going to have on the economy and people's ability to actually earn money, automation, artificial intelligence, what does it mean for the concept of universal basic income, for lack of a better term? Something we talked about offline when we first got together, but something I think we should discuss online, in the sense that if you're worried about economic contraction, if people don't have money to spend, then there is no economy at some level, right? Individuals, this gets back to the personal debt, the private debt. So all these things are connected. Paul, you're shaking your head. Maybe you want to start the comment first, but I want to understand what the impact is on automation, which I think is a gigantic threat to sort of individual people having real jobs, to their ability to then have income to spend on things, starting with food and shelter.
Look, I mean, there's some fantastic points there, Michael. We could talk about this alone for hours, but I think, you know, one of the key issues is I've become more of a adherent of job guarantee than UBI, because there's a lot of non-immediate, and I know people say, what's the difference? But actually the job guarantee, if you give people some work to do, it makes a massive difference compared to actually
Agreed. In other words, you don't want to just dole out money to people, because people have actually integrity. People get integrity out of work. They want to do something. Nobody wants something for free, and the people that do want something for nothing are edge conditions.
Absolutely. There's a lot of research that totally bears that out. So I think that's the first thing. But I think the issue is, you know, AI should enable that. The only reason why AI won't enable that is actually the sort of you know, the policy blockage that we're likely to see. And, you know, when I hear a lot about how JG is the answer, job guarantee is the answer, when I hear a lot about how people using MMT productively is the answer, and even, you know, to be fair, when I hear Steve talking about the digital currencies, you know, my big problem is actually the people who are currently enacting policy are the people who've been enacting policy that got us into this situation to start with all the same interests and vested interests. I'm not sure what's going to make them change, to be honest, Michael.
Yeah, I'm not sure what's going to make them change either. Does anybody else have a comment on what the impact is of whether UBI or guaranteed work? Or
I think Paul said, I mean, job gives people a purpose, and when people don't have a purpose, that's where you get social, you know, anarchy in going on. I mean, we're always worried about whether technology is going to create more jobs and take it away. And again, that question is still unanswered, but there's no doubt that this trend is accelerating in front of us. And policymakers have a very, very big question ahead of them, how they treat this. 100%.
My point on the UBI is that if we're forced to have a massive reduction in energy use, which I think we'll be forced into, then when that happens, we simply won't have the energy required to give most people work to do, because most people work as adjuncts to machines. If they're doing anything productive, or they work in, pardon the expression, but bullshit jobs, which don't add anything into the economy anyway. And you'd be better off with them without the jobs being done. I read David Graver's book on that, which I think is quite marvelous. So in that situation, what we need for is more their spending power, and to spend that on basic commodities to keep everybody alive, rather than elaborately transform goods and luxury manufacturing. So in that world, I think for a while, UBI will be necessary. We certainly won't have enough capacity to employ people who are put out of work by the reduction in energy consumption we're going to be forced into. And in that situation, a UBI at least lets them finance their financial commitments and keeps the demand working for the essential industries during that period.
Can I just quickly say, I think the fourth industrial revolution, or whatever you want to call it, will be very disruptive. I think we have seen that already. Often we're told that one of the silver linings of this pandemic is this acceleration towards the digital economy. But I think there'll be, some negative impacts that we should prepare for. There'll be lots of jobs that'll be lost, but lots of jobs will be also created. But there'll be a rise in inequality, I think, both within countries and between countries, depending on, how capable individual nations are in sort of dealing with these disruptions, right? But, if you look at every industrial revolution, right, every time there has been this concern about massive job losses, right? And every time we've told, oh yes, but this time it's a bit different, not like the last one. And that's because after every industrial revolution, the number of jobs increased, welfare increased, and livelihoods, living standards improved after every revolution. Of course, now you're hearing again, this time it'll be different, right? I don't know. I think history is a pretty good guide. I think there'll be a lot of changes, right? Every revolution is different. But I think it's easier to imagine the job losses than it is to imagine the new jobs that will be created sometime in the future. But a lot of disruption nevertheless will occur, right? And maybe we will be able to, survive this revolution as we have previous ones. Let me stop.
Just to push back very slightly, I'm not sure I'd accept the contention that living standards and welfare have got better with every form of industrial revolution. There's a lot of argument that actually in the UK, living standards peaked in the 15th century.
Right. Okay. Let me qualify that. I mean, I think you can't apply this to every country, but if you look at, general social indicators across the world, the number of people, who had, were pulled out of poverty and had their, mortality rates reduced, who had, their general health conditions improved. If you look at those sorts of indicators across the world population, then you would see, pretty secular improvement. But I accept that this can vary over time across individual countries. Sure.
We also have the issue whether that can be maintained if we're forced to reduce energy consumption by, say, 50%, which I think we'll all be forced to do. The large part of the increase in living standards is increase in energy consumption per head. Now, if those can't continue, then neither will those periods of conformance. So this is not your usual technological revolution.
You said that every time. They've said that every time. So let's wait and see.
Well, every other one's involved in an increase in energy consumption. This one doesn't. This involves halving.
Let's wait and see. Okay. We can't hear you.
Can't hear you.
So if only in the real world we could mute and unmute ourselves, it would be a great thing. Because normally most of the things we're saying are noise. But I think what I was saying was not noise. And let me just give like a sort of structural framework for this. We went through, I'm going to have very broad strokes here because we don't have a lot of time left. But if you can agree that we went from an agrarian economy to an industrial economy, from an industrial to a knowledge economy, and now we're moving from knowledge into digitalization, automation, artificial intelligence, and machine learning. The question we have now is, again, as everybody says, is this time different or is it exactly the same? And I think in all of those situations, there's a gap between the time where people can go from agrarian, meaning farming, to industrial, meaning it's going to work in a factory. Do people that work on a farm have the skill set to work in a factory? Maybe they do, maybe they don't. And do the people that work in an industrial economy have the skills to work in a knowledge economy? It's a good question. But the idea is, how long does it take to get those skills, right? And I think Steve brings up a great point. As we move into, because in the agrarian economy, we didn't use nearly as much energy. As we move into the industrial economy, we used more energy. Now we're using more energy than ever. And now we're understanding the impact of that energy, not just on the economy, but on the earth itself. And as we move into this digitalization and artificial intelligence and automation economy, how long is that gap going to be? Where are there skills that people can do? And I have often been a believer that humans are super adaptable. But if we have to reduce energy usage,
types of energy, isn't it?
I understand. But there is a vested interest that exists today that wants to use energy that's not beneficial to the state of the earth as it is today. So we have to figure out how to do that. But what's the gap? Anyway, let's go in reverse order from where we went before. Jack, let's start with you if you have any closing comments.
No, I just, on your last point there, I mean, Professor King brings up some great points about energy consumption. we're changing already. I'm picking school for my two young daughters now, and they're going to primary school and they're learning about coding and different things that we didn't learn about previously when we changed our economy. So I tend to be an optimist. I tend to think we are more resilient than we give ourselves credit for. There are outstanding issues in the global economy, and global warming is a big one. And I think Professor King brings up some great points in terms of energy consumption, but I'm going to go for humanity on this one and say we do our best and overcome it.
And do you think we're going into a global depression or not?
No, I adamantly think we are not going into a global depression.
Dr. Menon, let's go with you next.
Well, I'll continue with the optimism that Jack has started. I think, again, the thing about, we have to reduce our use of, non-renewable energy, and that's happening, and adjust also, right? And will force that upon us one way or the other. But, there will be different types of energy that will be available that will produce a more sustainable outcome. But coming back to the topic of this whole discussion, I think we've gone into many different interesting areas, but I don't think there's going to be a Great Depression 2.0. I think there will be a deep and prolonged recession, which we are already beginning to see with massive unemployment. I think massive rise in poverty, which will take maybe decades to reverse, which is the greatest concern. And a lot of that is happening, again, not because of the virus, but because the way we've responded to it, right? By locking down economies, by locking down economies or having stringent safe distancing measures, when in fact, I think we should know by now that, selected measures targeted at vulnerable groups is the way to best balance lives and livelihoods, right? And in poor countries, it's a false choice, right? Livelihoods are necessary for living, right? When governments cannot provide safety nets. And so I think, no depression, based on the conventional definition of, this downturn lasting 2 or 3 years. But there, it doesn't matter. There's going to be a massive pain that will last for a long time. And, my main concern is that we don't return to the lockdowns that will further cause permanent impacts. And there will be permanent impacts already, especially on the poor. Let me finish.
Paul, do you want to go next? Thank you very much. Paul, do you want to go next?
Sure. So, going back to where I started talking about World War I, as it's now known, the policymakers who got us into that war got us out of it by a solution that didn't solve anything, and it kicked the can down the road for a couple of decades, and then we started all over again. And so, is this Great Depression 2.0? No, I don't think it is, because I think that policymakers today, economic policymakers, have tools to kick the can down the road. I think we'll see stimulus on a scale that we haven't previously seen. And so I think they can certainly delay it. Will we completely avoid it? That's a much harder question, because that requires a total change of mindset. It requires embracing a lot of the things that all this super smart panel have been talking about. And sadly, I think the average IQ on this panel is an awful lot higher than the average IQ of policymakers. So if we were in charge of the world, yes, I think we'd find a way to avoid it. Sadly, we're not. So I don't know. I still have no idea, but it's going to take a change in attitude from people in power that I just find it hard to envisage what's going to drive that change.
Well said. So before we thank everybody for doing this, Professor Steve, would you like to leave us with some closing thoughts?
I'm going to hold the line on the Great Depression 2.0, and I think it's just the beginning of it, because firstly, in terms of energy, if we actually convert it over to completely renewable energy now, including hydro as well as solar and wind and nuclear, we'd be dropping energy output by 85% across the planet. So we're not at all ready for that. And we will be caught in a dilemma between whether we reduce the damage we're doing to the climate, or we or we continue producing. And for a while, nature won't care which decision we make, it'll make the decision for us.
Pretty much.
On that basis, I think, yes, I see a depression coming. The policymakers should know what to do. They do have the tools, but they're still not understanding how to create money and balance what's happening in the private sector. If they did understand the accounting side of modern monetary theory, they'd know there was no problem with providing that cash flow. They don't. They'll continue taking the cash flow away before the system recovers, and that will continue having people deciding to go back to work before they should, and the damage this virus is doing will continue. So I'm afraid I have a very bleak outlook for the next 10 years, and the good year is 2020.
Okay. I love the fact, I just want to say this, I love the fact that there's a massive divergence of opinion. I'm going to come down on the fact that I think we're in a very dangerous situation. Nobody's asked me for my opinion. I don't think the level of the stock market matters. What I do think matters is the amount of people that actually are able to live and sustain themselves, and whether the planet is actually able to sustain itself as well. And I think that these converging factors are going to make 2020 kind of look a little bit like, as Professor Steve was saying, a bit of a picnic, because I think we're heading into, I think that this regionalization is going to make things much harder to coordinate a global response to what's happening, not just from climate change, but in energy usage, but also in the idea of whether you call it guaranteed work or UBI. People need to be able to eat and to have a place to live. These are basic human needs. And if they don't have that, do we have 7 billion people on the planet, or do we go back to having 3.5 billion people on the planet? Anyway, before Barney, you finish, I just want to personally thank everybody for doing this. Professor Steve Keen, Dr. Jayat Menon, Paul, thank you, Mr. Paul Gambles, and Jack Kuzi for doing this, and also for Confex Hub for hosting this, arranging this, and making sure that this entire conversation was possible. So thank you all very much. Barney, back to you.
Thank you, Michael.
Thank you.
Once again, we would like to thank all our panelists, Professor Steve, Dr. Jayan, Paul, and Jack for joining us today. A very lively and insightful discussion indeed. And as always, Michael, thank you very much. It's always been a pleasure to have you with us.
Thank you.
Fantastic. And to all our viewers out there, thank you once again for watching Expert Insight at Live. If you missed some parts of this live broadcast, you can, of course, log in again and watch it on demand. To support our initiative in providing more industry and market insights, please subscribe to Confex Hub channel, switch on the notification, and get notified on our Expert Insight at Live on-demand videos. Do follow us on our LinkedIn page, FB page, and Twitter for more interesting episodes and topics on market, policy, strategy, technology, and innovation in your economic sector that have steered the industry growth. Coming up next, accelerating digitization in SMEs beyond coronavirus crisis, how to pivot and transform for immediate revenue, September 1st, 2020, 2 p.m.